We believe these technologies are going to scale in the global equity markets from $8 trillion now to $210 trillion by 2030. What's fascinating about young people today is many of them are natively digital, natively interested in technology, and understand that technology does solve problems and make our lives better.
But do they understand the risk?
I think they certainly do after the last year and a half, but even before that, as we were going into COVID, in a 1 month period, we were down 46%. If you look at ARC's entire lifespan, its fund span, roughly 8 years now, you'll see that there have been risk-on, risk-off periods. And our client base, our asset retention has been phenomenal because our clients know that you average down into periods like this. And they also know and are learning as they study the various benchmarks and indexes out there that they don't have the kind of disruptive innovation that our funds do. We are a great diversifier. We think most individuals and institutions are short truly disruptive innovation and that we can help diversify them. The last 20 years, 22 years, have been characterized increasingly by a shift towards passive investing and benchmark-sensitive investing. Why is that? It is because of the tech and telecom bust, and then again, 08, 09. And many people saw these benchmarks, the passive indexes, doing better than investors who actively manage their portfolios. Well, this was part of a self-fulfilling prophecy. If you have the pendulum swinging towards these benchmarks and towards passive, they probably will outperform. But if we are right, and for the first time in history, we have 5 innovation platforms, 14 technologies, the seeds of which were planted more than 20 years ago, all ready for prime time now, all ready for exponential growth opportunities. What that means is the traditional world order is going to be disrupted. How? These 5 innovation platforms, they are going to impact every sector, every industry, sub-industry company. We use our research. The screen for our portfolios is not a backwards-looking index. That would defeat the purpose of investing in the future, right? The screen is our research, and we give it away so that our clients and others can understand why we're investing in these technologies, why we think they're so important, and why they should get on the right side of change. This is part of our mantra. Many people think they are exposed to our kinds of strategies, the disruptive innovation with NASDAQ 100, for example. They are not. If you look into that index, which you find FANGs, NVIDIA, good company, Tesla, we own the last 2, but we have not owned the FANGs for quite some time in our flagship strategy. And if you look down below in the other 50% of that portfolio, you'll find food stocks, you'll find brick and mortar retail, you'll find utilities, you'll find energy. If people want innovation, they should invest, someone should provide them with innovation and not a hedge. Their advisors can hedge, or they themselves can hedge. You can hedge with cash as well. If you think about innovation that's going to disturb the traditional world order, who are the big banking clients of these banks, right? Mm-hmm. The traditional world order. They give them a lot of business. And these littler companies, smaller companies, are nipping at their heels and they're basically dismissing them. And so we are the only company, I think, doing the depth of research on truly disruptive innovation out there. And we are also doing something else that traditional research firms do not do anymore. They used to when I started in the business. We are focused on a 5-year investment time horizon for our public portfolios and now for our public-private crossover fund, longer still. This is what's missing in this market, this very short-term behavior that has forced management teams into basically catering to short-term desires like buying back shares, paying dividends, instead of investing in innovation. I do believe that during the past 20 years, we have been through the most massive misallocation of capital in history. This move towards indexation, what is it? It's investing in the past. The companies at the top of these big benchmarks are there because of past success. If we are right, and there are 5 innovation platforms, which include 14 different technologies, all evolving at the same time, and S-curves are going to be feeding S-curves as they converge, then the traditional world order is going to be, we think, severely disintermediated, if not destroyed. We focus on something called Wright's law. Wright's law is a relative of Moore's law. Moore's law is a function of time. Wright's law is a function of units. And Wright's law is working better in the semiconductor industry than Moore's law is these days. We center our research around understanding how technology learning curves are going to translate into cost declines, and how soon these technologies will become inexpensive enough for broad-based access. So that's what we do, technology by technology. The 5 major platforms right now are, one, we used to call it DNA sequencing or the genomic revolution. Now we call it multiomics, because we're not just talking about DNA, it's RNA, it's proteins, it's, biology is extremely complex. This is going to, we believe, bring about cures for disease. We're already seeing it with CRISPR gene editing in beta thalassemia, sickle cell disease, ATTR. These are cures. And one of the companies in our portfolios is sure that they will have the answer, meaning cures for diabetes, which is one of the biggest costs in the healthcare system around the world today. So multiomics, robotics, which we don't think is going to replace jobs as much as increase the productivity of human beings, especially collaborative robots that are covered in sensors. Energy storage, so electric vehicles, artificial intelligence. Artificial intelligence training costs are dropping, according to our estimates, by 60% per year. The breakthroughs in AI are astonishing even us. We expected, for example, computer programmers to increase their productivity with AI, with something called Copilot now. In 10 years, it happened in 6 months. So again, truly disruptive. And then the last one is blockchain technology, which, if you think about the internet, many people say to me, oh gosh, that's where, we were in the tech and telecom bubble right now. We beg to differ. Blockchain technology basically is providing us what the internet was lacking when we didn't understand that it would involve commerce. And if you look at the cost declines associated with each of these technologies, you look at, and Wright's law says for every cumulative doubling of units produced, costs decline at a consistent rate for each technology. DNA sequencing, 40%, or if you're talking about long-read sequencing, 28%. Robotics, 50%. Battery technology, 28%. Artificial intelligence, I just mentioned, we're getting our arms around what this is, but AI training costs dropping 60% per year, and these breakthroughs, astonishing breakthroughs.